All right, everything looking good on my end. We are live. Let's go ahead and get this stream started. If you are in the comments, just let me know you can hear me coming through loud and clear or in the chat. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on February 13th, 2022. Before we get started, I'd like to remind you, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So we have been talking quite a bit about the 2 and 10-year yield curve and the impending inversion and the likelihood of recession pretty much being 100%, and the 2-10-year inversion being the catalyst or the sign every time before it happens. So let's go ahead and just keep that in mind. Obviously, we got that CPI print, new high, 7.5%. And now the Fed obviously is considering an emergency rate hike. I believe they have a meeting scheduled for tomorrow morning, and they will determine if they're going to go ahead through with that. They have already stated previously, or Powell has, that they do not plan on doing any rate hikes until they have concluded their bond purchasing, which is not concluded yet. It does not finish until March. So they're still technically purchasing treasuries and mortgage-backed securities. So they would have to, assuming that he is going to stick to that, they would have to halt their purchases altogether early. And then on top of that, do an emergency rate hike. I'm not sure that that's going to happen. The thing about this whole situation is there's literally like months, potentially even years, from when they start making these changes to when we see actual changes in like real life. So other than like the whole psychology of it and the way the market responds, we don't see these actual changes in the real economy for like 6 months, 9 months, 12 months. So the idea of them just like doing an emergency rate hike, a couple weeks before March, like this is just going to like change everything. It's all just a psychological game. I mean, it doesn't really change anything, not anytime soon at least. So we'll see. We'll see how it goes. It is what it is. We've seen all this coming for some time. I do expect inflation sometime in the next couple months to basically top out and start coming down. Realistically, I mean, all these numbers are year over year. So because we're seeing elevated numbers from last year, the longer this happens for, the more likely we are to see the year over year change come down, because we're going to start getting into months where we were seeing inflation already. So eventually it'll, relax back out. Now, will the prices come back down? Well, it's the difference between goods and services. We're seeing inflation on a lot of goods and services that I think probably will not come back down. If we have less people providing goods or manufacturing goods, or trouble getting those goods, or we have less people providing services because they're too busy, doing whatever else instead, then obviously if the demand stays the same and the supply goes down, we would expect the prices to go up. So goods and services, no, I don't think the prices are going to come back down. Maybe they will eventually over time as we go into recession, slowing economy, etc. But as far as asset bubbles and asset prices and speculative assets, whether it's real estate, whether it's crypto, whether it's stocks, whatever we're talking about, yes, I think that we will see, bubble pops, crashes, return to normal in a lot of those things. And we've already seen in quite a few, like, if you don't have earnings, you're already suffering heavily. So, but, that's the difference between trying to paint everything with a broad brush and saying, inflation's going to come down, or asset prices are going to come down, or we're going to go into a deflation or stagflation, or whatever. You can't just paint everything with a broad brush. But we are seeing the key things that we know every time leads to recession. We're seeing the yield curve inversion extremely close, and the 2 is fast accelerating on the 10. Obviously, you saw the thumbnail, and then I've showed off that chart quite a bit. That's all pre the Fed actually hiking rates too. That's all the market doing it for us. So we're obviously seeing flattening and yield curve inversion on the long end of the curve, and we're very close to seeing yield curve inversion on the middle and short end of the curve now as well. So you know, it's all but inevitable at this point in time as we fast approach that descending trend line. We don't want to see a breakout of that trend line, as that would obviously be a change in trend for a 40-year downtrend, which is going to probably lead to some craziness in the markets and in people's lives. So we will take a look at everything, get an idea what's going on. But remember the 4 things we've been paying attention to. Obviously, the 210 is number 1 thing we're paying attention to. Second is slowing transportation. So when we start to see the transportation sector peaking and prices starting to come down, we know that's signs. And why do we look at that? Because transportation, everything has to get transported. People get transported, goods get transported, everything. Transportation affects everything and is affected by everything. So we're watching transportation. We're watching the yield curve, because what is that? Well, that's, you know, the cost of money, the price of money. And if we tighten up the price of money, people have less available, therefore they will have to use it, you know, in better ways to make sure that they can get that yield and beat inflation and beat the cost of, you know, the interest rate or whatever. So as that tightens up, as transportation prices start to come back down, those are 2 main things. The third is semiconductors. As we start to see semiconductor stocks topping out, semiconductor sector, we pay attention to that. And then, of course, the 4th one is energy spiking. And all of those things have been, that's our 4 pillars, the 4 horsemen that we see every time we go into a legitimate big crash in the stock market, you know, in the world economy, etc. So we saw that happen in, you know, 2000. We saw that happen in 2008. We saw it happen leading up to 2019. And now we're seeing those potential same things happening again. And the number 1 that we're paying attention to right now, the big outlier, is oil breaking out to prices that we haven't seen since, you know, 2014, fast approaching all-time highs. We're seeing not as much in the United States, but many energy prices spiking as well. You know, here we're not having the same issue with nat gas because we're, you know, a producer and exporter, but obviously we're seeing that in Europe. Here we're not having the same issue with coal, but we're seeing that in a lot of other countries, you know, Europe, Asia, etc. So we have to look at this from the world perspective, not just a lot of the U.S. is probably more guilty than anyone, in my opinion, at looking at things only from our own perspective, like just looking at the United States and not paying attention to anything else. And I think it's very important for us, all of us, to pay attention to the world much more than just our own local country or government or whatever. So yeah, let's go ahead and jump right in. That is obviously 4 important things that we're paying attention to, watching to, and I cannot stress enough why those things are so important. Good to see you, brother. Yeah, crazy week for sure, man. And lots more craziness to come. Obviously, we have a lot of, you know, there's a lot of financial stuff going on, a lot of different things going on, as well as, you know, geopolitical things going on, you know, corresponding with those same events, those same time periods, those same crazy crashes in, you know, the markets. Obviously, 2000 was the dot-com bubble burst. And we also had, you know, geopolitical events taking place as well. And then 2008, same thing once again. 2019, once again. And now we're seeing like escalation between, obviously, you know, China and Taiwan, Russia and Ukraine. You know, which came first, the chicken or the egg? Is there already about to be something happening in, you know, the markets or whatever, and then the geopolitics gets involved? Is there something happening in the markets so then they cause a geopolitical event? Is it all just random? I mean, who knows? But we see a direct correlation between things like, you know, 9/11 and the war on terror, you know, Desert Storm, you know, and the whole Middle East conflict, you know, the Taliban and all that deal. You know, I mean, it's one thing after another. So, in my opinion, obviously not random. You know, going back to, you know, the last 100 years, we can see a lot of these same events obviously correspond with, you know, various other things taking place. World War I, World War II, Vietnam. I mean, you can literally look at an asset chart and like the Dow Jones, and you can literally see when these key events were taking place. directly correlate with stocks, stock prices, etc., energy prices, all these different things. So, it's not random coincidence. You have to look at causation versus correlation, but the fact of the matter is these things are all related. So if we can understand the relationship between them, we can better understand the markets and position ourselves to, benefit, or even if you're not trying to benefit off these things like in a shallow way, but, not to suffer the consequences of these things. So let's jump right in and take a look at some charts. So we'll start with the 10-year. Obviously, we came up and we finally did hit our 2.0 target almost perfectly. We had a little sell-off, pullback after that. Not unexpected. We are putting a little bit of potential bearish divergence. If we just pull up our drawing tools, we'll see we literally tagged the Fibonacci to the T exactly. Obviously 2.0 is a nice even number as well, but that is our yellow fib from the top of our 2018 peak at 3.25% all the way down to the wick way down here in March of 2020 at 0.396%, and this is again on the 10-year treasury yield. And then we see that the Fibonacci levels obviously have been playing key support and resistance the whole way up, and then we obviously broke out of our the handle of our cup and handle, or the inverted head and shoulders pattern, and now we have broken up to our first target of the breakout, which is our 786 Fibonacci extension or Fibonacci internal retracement. The next target will be the 886, longer term, obviously, which is going to put us at 2.565. Obviously we touched this one perfectly, so it would not surprise me if we came up and touched that next one perfectly. Now, when is that going to happen? We don't know. Obviously, it might take a little time, might not. I mean, the way that the 2 is accelerating towards the 10, I mean, the 10 can't get up there fast enough because the 2 is literally on its tail. And when we saw this little pullback on the 10, the 2 pulled back almost exactly the same amount. So the 10 is accelerating to the upside. The 2 is accelerating to the upside much faster. And then when we have the pullbacks, the 2 and the 10 are pulling back around the same amount. So, it's just a matter of time basically before the 2 passes the 10 and we have full on yield curve inversion. And then after that, we typically see recession take place within, a couple months to, a year or so, and depending on how long the recession lasts. Obviously, the 2019 CVD one, we technically came out of that right away. But, I mean, did we really come out of it if we're just right about to go back into one again? Or did we just buy time before, we got to pay the piper? So, obviously, still very bullish on this. Short term, would not be surprised to see at least a temporary pullback. But we can just take a quick look at our monthly chart. I'm going to turn off the drawing tools, and we see very clearly that the almost what I would consider to be the inevitable target to the upside is like that 2.6 level, which is essentially just the retest of the 200 exponential and simple. And we did finally confirm something that we have been watching for some time now, which is, we finally flipped the slope line over blue on the TJD TDMACD. So we now have officially confirmed the slope line blue. We have a very bullish, left the bearish control zone, hard buy signal. We're all the way up here. We tapped our head the first time at the bullish control zone, literally perfectly, and then had a small retracement. And now we're back up here, pushing back up, and it looks like we are ready to enter into the bullish control zone. Everything's just playing out as expected. We see the previous time when we did that was right back here. We did the same thing. We came back down, consolidated, and then we shot up and tagged the 200 exponential and simple. And then we see here, we banged our head on the top of the range, came back down, and now we're potentially coming up here to tag the 200 exponential and simple. So very, very bullish. Obviously, the 8 and 21 have crossed to the upside. So the next target is an attempt to break through the 200 exponential and simple. Every other time it has happened for the last 40 years, we have gotten rejected once, twice, 3 times, 4 times, 5 or 6 times, depending on how you want to look at that. So more than likely, will we get rejected again? Sure. If we break through that level, though, and start to consolidate on top of it, that will be a change in trend and something that we haven't seen take place in 40 years and definitely worth paying attention to. And if we just turn off our log scale for a minute, we will see essentially we basically have this maybe we basically have this channel that we have been operating inside of for some time. Why is our channel? Hang on one second. TradingView getting a little squirrely lately. I don't know what the hell is going on with them. But they did fix our most recent issue, which is good. So we have in green right here our, let me turn off the moving averages so it's a little more clear. So we have here in green our channel. Man, I don't know. All right, that's much better. So we obviously have just been operating inside of this channel with the exception of the peak, which was obviously the 80s. And then basically have just been coming down, and we have been perfectly tagging the bottom, top, bottom, top, bottom, top, the whole way down here. And essentially in a, we technically entered into this channel in 1985. So, at this point in time, we're essentially like almost 40 years in this channel and potentially looking like we're bottoming. And then if we get back to the top of the channel, which is essentially that 618 here in yellow, everything's going to look off because let me switch back and put on the log scale one more time. There we go. So it's back at our 786 in yellow. So if we push back up here one more time and tag that 886 at the 2.53 level, that's literally going to put us at the top of this channel outside of it. And then we have to pay attention for the measure move break of the entire channel, which is when we get into our blue measure moves right here. And I'm going to tell you right now, if we break out of a 40-year descending channel to the upside, that's going to be something crazy. This would correspond with the bond market getting absolutely wrecked. And then we know that there's a ton more money in the bond market than there is in the stock market. So if there's money coming out of the bond market because the bond market is crashing, we know that money has to go somewhere. So that's going to cause probably what I suspect will be, the biggest rally of most of our adult lives in, what I imagine will be commodities, maybe cryptocurrency. Who knows? We'll have to wait and see. All speculation right now, but if we start to see some of these things playing out, we know what that's going to look like, and there's going to be a lot of wealth destroyed and also a lot of wealth made. And that's our job, is to make sure that we're positioned accordingly to take advantage of both those situations. Oh my god. All right. All right, we're just going to keep going on here. So U.S. oil, we're going to take a look at next. So U.S. oil, man, TradingView, get your life together, please. So we obviously are peaking in that same area again, potentially at the top resistance here in red. Once again, we're nearly to our target of 97.41 and that $100 oil. It sounded crazy when we were back here and we were bullish on oil at 40 bucks, and Kathy Wood was calling for her $3 to $12 barrels of oil, and now here we are almost at 100, potentially getting ready to break out of this long pattern. We'll have to wait and see. Each time we have previously tapped this resistance, we sold back off. So at this point in time, I think there's more likely than not we will do the same thing once again. But we have to assume it will act as resistance until it doesn't. So I do expect this to top out, roll over right here. Now, a catalyst for this breaking out could be, sanctions against Russia, or, whatever should happen if they decide to invade Ukraine, and, the U.S. and the EU and everybody gets together and says, bad Russia, now you're sanctioned, and, then energy prices go through the roof. I don't know if that's going to happen. We can only speculate on that type of thing. What we do see here on the chart, though, is we have a sell by sell in the bullish control zone, and we're basically at the top of the range that has been acting as resistance over and over again. We see a peak here, we see a lower peak here, and now we see we're coming up with the blue and getting potentially rejected by the pink. So more than likely, I think this is going to roll back over. Now when it rolls over, are we going to put another drive of bullish divergence and another higher low and then continue to the upside? We'll have to wait and see how everything looks then, but probably just going to keep doing what we've been doing. So Dow Jones is next. So just looking at the Dow here, we basically have our peak. We came down, put in a lower low, and then we came back up and put in a lower high, which is exactly what we didn't want to see. We did come right back down to our red support line that has been acting as resistance previously, and now it's acting as support. We're also right here at the 200 exponential and simple, we broke down from the 200 simple. We're at the 200 exponential. They're starting to lose their slope. We know this is starting to look like a peaking pattern. Now we are seeing the slope flip over on the TJD TDMACD. We did enter into the bullish control zone, but we immediately got rejected. So at this point in time, it looks like it's just trying to make up its mind what it's about to do. Now my bias naturally, based on our longer time frame charts, is that we're going to eventually break down from here. But in the meantime, we really just have to let the market, play out. We have to let it do its thing. We're at a very key support here. We have the red ascending support. We have both our 200 moving averages, and then we have the green horizontal support. So there is quite a bit of support here. So a break of this level to the downside will be aggressive, as it will be very clear to anyone watching any of those things, let alone someone watching all of those things. So the S&P next, same thing, came down to the 200s, bounced up, put in a much lower high here. Now we need to pay attention, obviously, if we lose this area and break down from here. The key levels to watch are obviously the low right here at 431 or the low right here at 428. But once again, we're seeing the 200 simple above the 200 exponential. We're losing the slope. It's starting to flatten out. Once the 200 simple is on top of the 200 exponential, we know typically, we're losing momentum. We're starting to top out. We're maxing out the jewel thief. It looks like a hard rejection here on the histogram. Does not look particularly well. And those are our two good indexes, or better indexes. So here we see on the Nasdaq, obviously we broke down from that key area. We were potentially looking at this as what could be a head and shoulders, as we see that often play out. And then instead we just broke straight through the neckline. We came down, we hit our measure move, came back up and put in a lower high. And if we turn off our drawing tools, we see we have actually lost the slope on the 200 exponential and simple, and the Nasdaq has officially entered into a bear market. So now we're just going to watch these key levels. We have level at like 13,338, or somewhere closer to like, basically 13,000, and then after that, a slight step lower than that at 12,588. If we start to lose those levels, this thing starts to really look like it's in trouble. And obviously the measure move breakdown from the top to the neckline would give us a breakdown roughly somewhere around like 12,000. And then obviously we have target areas a little bit lower than that. But we expect slinky theory to fully play out as we essentially just step down the stairs. Russell is next. Obviously the Russell is the weakest of our indices. So we see obviously we're trading inside of this range forever. We had the throw over rejection, came back down to the bottom of the range, came back up to the heart line, got rejected. Full on in a bear market, 200 exponential and simple have rolled over. And then we couldn't even get the push all the way back up to get rejected at the bottom of the range. What was support could have acted as resistance, but the Russell was so weak, we may never find out. So basically, we have a little bit of support here along the way up. If we break down from these levels, obviously losing the 1930 level is going to look really, really bad. And we would just full on expect the Russell to just start puking value. And I mean puking. I mean, this thing already looks so bad. So if we just put in a Fibonacci from our CVD bottom back here, that Rona low, we know obviously we consolidate at the 236, came back up, got rejected. So our next target to downside would be the 382. Again, we would expect slinky theory just kind of step down. We're not just going to expect one giant candle down. Now that doesn't mean it doesn't happen, but we don't expect that. So, our next target to downside being like the 382 is going to give us roughly a target down here in like the 1720 range, roughly. So that's what we're paying attention to. Obviously, we have the hard buy coming out of the bearish control zone, but we're getting a pathetic move back up to the upside. We do have the slope flipped over blue and a bunch of green histograms, but again, it's absolutely pathetic. So if we just, to basically compare this, we see that from essentially the zero line right here, this is where price action was. And then we sold off this much and came down, and that was our peak. So from here to here on the indicator oscillator was from here to here. And now here we are the majority of the way back up, and we haven't even retraced, like, not even close to half of that move, maybe a third of the move, and we're almost back to where we were. So we know what's happening right now is what I like to refer to as a bullish reset, where we have a pathetic like dead cat bounce. The indicator oscillator trends back to the upside, and then it resets, and then we can get further downside potential. Because we can't just go down forever. Eventually you're overbought or oversold, or, depending on like how you look at the metrics or whatever. I don't really like those terms in general. I prefer like bears or bulls being in control. But there is definitely some validity to, running out of steam. And we look at that as divergence and look for divergence. telling us when that happens, as where other people just look at levels and say, okay, the RSI is at a really low level, historically low, so it must be oversold. But I look at it the other way, that the bears are clearly in control, the bulls are dead, they've been skinned, they've been scalped, they've been ruined, and then the bears are clearly in control, but eventually we'll see divergence, and then that's when we'll get the bounce. And that's obviously a much more powerful, much more useful way of trading. But, you know, obviously not everyone's doing technical analysis the same way or as successful as we are. So, oh man, already we got a bot. Ooh, we got a bot, we got a bot, we got a bot, we got a bot. Nice. Peace out. So next we have the Nasdaq 100. This is the waddah chart. So basically just looking at this, we obviously have broken down from the 200 exponential and simple, had that retest, got rejected. The 200 exponential has already rolled over. The 200 simple is slightly lagging, but has almost a flat slope. So obviously does not look good. The stochastic in blue has already started to roll over back to the downside. So it looks like we are likely to get an impending cross. And then obviously the slope line has acted as resistance for the histogram, and it started rolling back over. We now have 2 red histograms on the daily. So again, looking very weak. And then obviously we took out the previous low back here with this low here. So if we take out this low again, we will start to go back here. Now, obviously this bounce that we saw was off of these previous 2 peaks right here. So that is a very clear, very strong support. So violating that support, we'll start to look at other key levels like the 12,960 range, or possibly down to the 12,290 range. But I mean, again, it's, you know, we have a peak right here, which acted as a support right here. We have 2 peaks right here, which acted as support right here. So we want to just keep looking at the areas that were resistance and support. But if we just slap on a fib from our CVD dump right there to the top back here, we can see we didn't quite make it down to the 236 technically, but a touch of the 236 would give us basically that 13,466 target. But then our next target to the downside would be the 382. So you could look at this as 2 different ways. Obviously, the Fibonacci would have some significance once we do get down to the 236. Pay attention to the moving averages. And then obviously those key levels that were acting as resistance or support are going to be substantial areas. So once again, just, you know, treat it like stairs. We're just walking down the stairs, you know, just paying attention to one key level after another. Why do I feel like TradingView is struggling again? Not touching nothing. So let's look at UPS next. So obviously UPS just a sort of like proxy for our transportation sector, and you know, just an interesting chart. As we did see, this thing is known to have big gaps and then fill those gaps. And obviously we saw once again, we had UPS earnings come out and we left this massive gap. And I specifically spoke about how I didn't think this was sustainable, but it was possible that we would get the measure move to the upside. We gapped up, and I said when we come down to the support where we broke out of, that range that we were inside of, that triple, quadruple top, the last thing we wanted to see was us break back down and fill this gap. But the likelihood of this being a breakaway gap was very low. So basically this just looked like a massive squeeze gap, and then it looks like we're going to come back down, fill the gap, and then we'll probably come back up and see that same level act as resistance again, 217, and then potentially see it just start trading back inside the range again. But we have to be careful because this is a textbook distribution pattern. We trade sideways in a range for a long time. We finally fake breakout to the upside or have what we call a throw over or a failed breakout. Maybe it's not even a fake breakout. Maybe it's just a breakout and people don't buy into it, so it fails. People sell into it because it doesn't just keep running. So essentially it's a stop hunt, or all the people that were short, their stop losses get hit, the price shoots up to the upside, or stop losses get jumped maybe, and then people buy into momentum, the breakout, but there's not enough people buy into it, so it starts to peter out right here, and then people get scared and go, uh-oh, why isn't it running? We broke out, we should be going, and then we don't. We start to come back and fail, And then what happens after that is we see 1 rejection, 2 rejections, 3, 4, and then 5 after the breakout. And prices obviously cannot go higher, or they would have one of these many times. So they come back down here and start retesting the bottom of the range. And then we often break through the bottom of the range and see the measure move in that direction. So we had the opportunity for the measure move to the upside, but it didn't happen, and we got the measure move to the downside. And a perfect example of this type of Wyckoff distribution pattern taking place is we can look at the Russell. This is exactly what the Russell did. So we have a very clear range we traded inside of right here in green. We finally broke out of that range, and then it, petered up here for a little bit and then failed. We came all the way back down to the bottom. We lost some moving averages, and then we broke down to the bottom, and now we're seeing that potential continuation to the downside. So this is a perfect example of what UPS potentially could be setting up to do right now, and it looks very likely. And we see the same thing over and over and over again, and that's the beauty of technical analysis is, it's the same thing over and over again. So the more we get familiar with these certain things, the more we're able to utilize them. What did I do over here? What did I do? Zoom in? God, I hate TradingView. Okay. Okay. So let's take a look at our commodities next. So we have gold. So gold was doing some interesting things here. Obviously, this was a key level we were paying attention to, this little high right here. But this is the real one we're watching. Gold needs to break above this previous peak to really show us something's happening here. And then after that, we pay attention to this peak right here. So the key levels we're looking for is a daily close above 1866. And then after that, a daily close above 1907. At which point in time, I will start to legitimately get bullish on this. Because we've had this pink resistance in play this whole time. And now we have technically broken out of that pink resistance right here. Now, unfortunately, we did that quite a few times on different time frames. I think if we go to a weekly time frame, this lines up much better. So we see where the weekly, maybe I had it on the monthly. I don't know what time frame I drew this on. Yeah, I think if we break out of this and consolidate, like close above this on the monthly, especially like with any kind of conviction, this will look very good. It will start to legitimately look good on gold's part. Now, I already like what the daily and the weekly are looking like, but I don't want to get overly excited until we see, a close above the previous high on at least the weekly. Because we see, obviously, we have just consistent lower highs here, and we technically have another lower high potentially. Now, even though we did break out of this descending resistance trend line in pink right here, we're still technically like in the range. We haven't violated any key levels yet. And these are the least reliable lines, are like descending and ascending trend lines. Horizontals are much more reliable. So if we break above one of these key fib levels, which obviously we have in orange here from the top to the bottom right here, our high, all-time high, to our low inside the range right here. We came up the first time to the 618, then we came back down for basically a double bottom. Then we came up to the 0.5, then we came down to 236 and found support. And now here we are back at the 0.5. So what we want to do, the best case scenario for this to build strength would be for it to come back down to the 382, find support, and then break back up to the 618. That would make me very bullish. And then obviously if we break above the 618, I could say with very high conviction that we would be going to new all-time highs. Not financial advice, obviously. And that would probably correspond with something like serious damage being done to the bond market or to the stock market or both. As people what's the old term? When people get worried, they spend their money on things that can drop on their toes or there's some essentially like a commodity type analogy. People run to like things that they can hold, physical things, and maybe crypto will be part of that. It'll be a digital physical thing. Who knows? But yeah, so gold starting to show some legit signs of life. But again, we've seen so many of these fake outs. This is exactly what, if I was looking to trap people in gold before we went lower, this is exactly what I would do. I would break through the trend line right here, not break through any legitimate key levels that change the game, and then I would just aggressively sell it back off and, trap people in the position once again. So not getting too excited yet, but definitely starting to see some life out of gold. Now, silver obviously looking still quite pathetic, very much just hanging on to the bottom of the range, completely underperforming, starting to build up a little bit of momentum, reclaiming key levels, but very much still in a bear market below the 200 exponential and simple. But I do want to look now at the gold-silver ratio chart because this is going to give us a better idea as to what's going on. Now, we all know, obviously, that gold tends to outperform silver early in bull markets, and then silver tends to outperform gold later on in the bull markets. We haven't really seen silver outperforming gold lately. Matter of fact, sort of the opposite. We saw basically from the peak here, which was the March crash, gold got up to 129, 129 silvers to 1 gold. And then when we dropped all the way down here, the absolute peak of silver when it hit $30, it was 61 silvers to 1 gold. And now here we have bounced back up to the 200 exponential and simple, and we're basically consolidating at that range. So the real question is, if we continue to consolidate here and go slightly higher, which my target was 90, around that level. If we go higher like that, that means probably that gold is either breaking out to the upside or gold is breaking down from that range. Because gold tends to be stronger early on the breakout, and then it also tends to hold its value better on a breakdown. So breaking up from here doesn't give us an idea whether, we're going to be going up or down on price necessarily. But breaking down from here is the opposite. If we break down from here, telling us that silver is going to gain value in relationship to gold, that tells me that the likelihood that we're breaking down on price action is very unlikely, because it's very unlikely historically that if we break down from that level that silver would strengthen compared to gold. It would be the opposite. Silver would lose value in relationship to gold. So gold would be selling off, silver would be selling off much faster. So if we break down from here, that actually tells me that silver is gaining value compared to gold, and more likely than not, that we're actually breaking to the upside. So while a break to the upside on this chart doesn't give me a bias one way or the other, it could easily be gold moving up or gold moving down, and then silver accordingly, just at a lesser extent. A breakdown from here, basically taking out like this 76 level, that, and then especially if we took out this 73 level, that would tell me that silver is probably going into like a massive bull market, and this could be the overperforming portion of like the later bull run that started essentially back in 2013 essentially. So we had essentially a low back here in 2016, and then it ran all the way up to 2020. So from 2016 to 2020, and then we had a low right here potentially, and then this could be our high, and then we could be entering into another phase like that. So we'll have to wait and see, but obviously like the macro low was back here, was when gold topped out in 2011. So we'll have to see. But we know that a break down from here tells us more about direction and price than a break up from here. So that's why it's so important to pay attention to the levels. Now at this point in time, it looks like a potential rejection off of the 200 simple, but it's also too early to tell because we did get rejected once, came down below the 200 exponential, and then came back up and reclaimed it. So as far as I'm concerned right now, we're essentially range bound at the 200s, and then we'll see how this corresponds. And then of course, global instability, might have something to do with that as well. So we will see. So if we just keep going on here. So we have silver juniors, SILJ. So we're basically finding a pretty clear bottom here for now. I'm not convinced that we don't go lower on this, but at least for now it looks good. We are still very much in a bear market, putting in lower lows. So I don't want to get overly, exuberant on this. But again, on the daily, if we start to take out like this little high right here, or potentially this high here, or we can even just get back above the 200 exponential and simple, this will start looking really good. The area where this looks legitimately strong is when we take out like 1450, because we'll be well above the 200 exponential and simple, and we'll have taken out this previous high right here. So silver juniors starting to look okay, potentially that we could put in a bottom. We're seeing some bullish divergence taking place, but we've seen quite a few drives of bullish divergence on this, and we've just continued to put in lower lows. So again, don't want to get overly exuberant on this. A lot of people are already very, very upside down on silver and gold miners because they just, followed the fundamentals and believe the narrative and they just got absolutely wrecked. A lot of people are down over 50% or more on their gold and silver miners because they thought, okay, I want the leverage play on gold and silver because gold and silver are going to go up because inflation. And now those people look like absolute fucking morons because they lost half their money and they've been trapped for a year. So careful with those fundamentals on things that sometimes take 10, 20, 30, 50 years. Because if you're early, you're still wrong. And if you're late, you're still wrong. So you can be right and you can be still wrong. Because if you try to time shit, most of the time you're wrong. So especially things that have like 30 and 50 year time horizons. So I would rather be a little late to the party and lose out on a little bit of gains, but have a very much higher likelihood of success than be early and then just get absolutely trapped or wrecked or lose half my money because I got greedy or I believed some BS narrative that obviously failed horribly. And you guys know I love gold and silver, but also I love my money and I don't want to lose 50% of it because I'm a greedy fuck. Like many, many people out there. No one in particular. But I mean, we could point some fingers if we had to. I mean, if you wanted a list, I could make one pretty quick off the top of my head. Many of them public figures. So GDXJ. So basically just the, so we looked at the silver junior miners. So now this is the gold junior miners. So once again, we see that we have quite a bit of bullish divergence taking place. We're operating still inside of this descending channel. We're tagging key Fibonacci levels from the low to the high right here. And then obviously acting as resistance and support along the way while we're inside this descending channel. So again, until we break above the 200 exponential and simple and the top of the channel right here, I'm not going to get bullish on this. So we really have to take out like the $44.31 level. So, I mean, how much further is that? And obviously we're at the 382 right now. You know, so I will wait 7% and then consolidation for a confirmed breakout because that breakout will probably take us back up to like 55. And again, I get that obviously from the key level that we have here from that previous peak. You know, obviously this would act as resistance, but also the measure move from the bottom of the channel. The breakout, assuming we just ran right up there now and we broke out, the measure move would take us back to that level, probably take it out, and then we know we're headed up to new all-time highs. Higher probability than not. So did we bottom already off of this bullish divergence and now we're going to explode to the upside? Maybe. I'm going to wait and see though. I don't need to rush and be the first one to the party because I'm not willing to just get absolutely wrecked like many of these people do. And we're at resistance at the 382 now. It seems very likely to me that we actually sell off one more time and come down to the 0.5. So maybe I'll take a position at like 36 or something like that. But as you guys know, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. I have been saying all last year and into this year that I think 2022 will be the year of what? What two things have I literally been saying this whole time? The year of the miners and the pot stocks. So that's my narrative for this year. Last year it was, oil, energy, uranium, all that good stuff. Before that, it was tech and crypto. So, I mean, we've literally nailed all the big moves, all the massive trends, all the just absolutely explosive sectors. So now we're going to do it once more. Now, you guys know where I think, I'm saying ahead of time that I think it's going to be pot stocks based on fundamentals and technicals. And then obviously, same thing with gold and silver. And then miners as well. Now, we're not just going all in right now, because we just assume that we're going to be right. We're watching these things, with a magnifying glass, waiting for our one thing after another that just confirms our narrative is correct based on fundamentals, based on technicals, based on key levels of resistance or support or divergence or moving averages, whatever it is that we're going to couple our entire plan on. We're not just going to say, hey, we have a narrative and we think pot stocks are going to be great because the government wants taxes. And a good way to get more money that they could waste is by legalizing pot stocks. Sure, that's a great narrative, but we don't know when that's going to play out. We don't know if we're going to be correct. But we have a legitimate narrative. We have a fundamental plan. We have an idea and a legitimate reason to believe that. But now we have to let the technicals really cement that into our heads. So when we get to pot stocks, obviously we'll look at that and we see Once again, bullish divergence. We see these things trading at massive discounts, based on like book value and whatnot. So, we're paying attention to this stuff, but we're not just getting overly excited and just going all in on this stuff because we believe in narrative, because that's how these people get wrecked and lose 50%. Because I'm still not convinced that the miners and the bot stocks have put in their lows yet. I would not be surprised at all to see both those sectors go lower, possibly even much lower. Now, do I think regardless, 2 years, 3 years, 5 years from now, that if you invest in the right things, these ETFs or these sectors, that you're going to be much higher regardless? Sure. But the real question is, can you take the pain in the meantime if we do see another 30 or 50% downside? I would rather not take the chance. I like to buy into strength. I like to identify bottoms and then buy into strength after they've bottomed, instead of just trying to pick the bottom. Now, occasionally I will take a scalp off of divergence or something like that, and it will turn into a very nice positional play where I get to say, hey, I bought the absolute bottom. But that is never my intention. It is never my intention. And that is very important to remember. Sometimes a very good scalp or a very good swing trade can turn into a beautiful position where you can look back and say, hey, look, we bought the absolute bottom. We're a genius. But that's not ever our intention, is to buy the absolute bottom. Never. On a positional play. On a positional play, we are always buying into momentum because we don't want to be trading in and out of that. So I think I made my point. I don't mean to lecture you guys. I know most of you guys know, but occasionally we get some new people that don't understand the rationale behind it. So, and also it's good to drive home the same point over and over again, and to make sure that I'm explaining how I'm thinking about these things, so that I'm not just saying something and you're like, man, I wonder why he says one time he's buying divergence and buying the bottom, and another time he's saying no, he's waiting and buying into momentum. Time is the biggest thing for me. It's a huge factor. And you guys know that I like to separate my accounts up between scalps, swing trades, and investments. And to me, I look at those things as completely different situations. So, and it's the same thing even with something like gold and silver. I might take a scalp play temporarily on silver or gold, but I'm not going to go out and physically buy gold and silver, to trade in and out of, because you lose money like that because of the premiums. But if I enter into a scalp trade, say like when silver crashed with CVD and went down to $12, say I buy into silver at $15, and then immediately it shoots up to $25 or whatever, I can then close out that digital position, and then I can go out and buy physical silver with it. And then I just pay the premium one time when I enter into it, and then I've basically logged my gains into physical silver. But I don't need to physically go out and buy that raw metal. And it's particularly important with gold and silver because the premiums are so high when you buy physical. So copper, I like to look at COPX. There's plenty of other ones you can look at, but this is the copper miner index. But essentially just looking at this has gone sideways at this point in time. We basically have a peak back here in January of 2021, which was the top that has now been our bottom. And then the actual peak on this was in May of 2021. And then we basically have just been range bound on these copper miners. Now, obviously, they have had a phenomenal move in comparison to gold and silver miners. And, obviously, copper has been absolutely crushing it as well. But we see very clearly here, we're respecting those fibs. So as of now, we're hanging on to the 200 exponential and simple. If we stay above here long enough, the 200 exponential might cross back up, and we could come up here and put in new all-time highs. But we need to keep in mind that copper is strictly a commodity. Silver is a commodity and a monetary metal, arguably only a commodity at this point in time. And then gold is, just a monetary metal with a slight taste of commodity. So we're sort of seeing the different ends of the spectrum. Silver's kind of in the middle. Copper is just a commodity. Gold is more of a monetary metal with a taste of commodity. And you could argue there's a tiny bit of monetary metal to copper, but it's mostly a commodity. There's definitely varying levels of those things. But they're basically opposite ends of the spectrum. So if we go into a massive commodity bull run, I would expect silver to do better than gold because silver is more of a commodity than gold is. If we go into hey, we're scared and everybody's running to monetary metals, I would expect gold to do much better than silver because big money is not going to go out and buy tons and tons of silver, literally like tons, because it's so big and heavy and you have to store it. But they would go out and buy gold because you can store so much value in such a small weight or space. You know, and that's why we see central banks have like gold on their balance sheets and not silver or copper. And if you're thinking about buying physical copper in like coin form or bar form, please don't ever do that. Please don't ever do that. I've literally have heard people saying that they're like stacking copper, and I'm like, you better mean like copper fittings, because I know you're not paying massive premiums for actual copper coins. I mean, you could buy, there's like cool copper coins that you could buy as like a collector's item, but if you ever stock, I'm not even, just don't. No. People get tricked with copper because when you see the price of copper, it's in pounds. And then they think, oh, copper's $4 right now. They don't realize that it's $4 a pound. And then they go on these websites where you buy silver and gold, and then they see a copper coin, a 1 ounce copper coin that looks cool and is shiny, and they see it and it's $3. And they say, oh my God, this is cheaper than copper price. What a deal. And they don't realize they just got 1 ounce for slightly less than what it costs for 1 pound. So careful. I mean, you guys all know. You all know. And if you don't, you do now. So no. But copper overall, you know, obviously paying attention to on the downside, that 32.47. We have to wait and see. This thing's just been going sideways forever. So we have a very clear defined range. You know, if it comes back up to 46.85, I would expect it to top out once again. If it comes back down to 32.77, I would expect it to bottom out once again until something changes. But as of now, we're just range bound. And I would expect that to continue. URNM. So this is just one of the uranium ETFs that I like to watch. You guys know I watch a bunch of different ones. But URNM, they all pretty much look the same at this point in time. We could look at Cameco because it's like a little bit bigger, but I just happened to pull this one up. So URNM, North Shore Global Uranium Mining ETF. We obviously broke down from a key pattern, hit the measure move, found support temporarily at 200 exponential and simple, broke down below them, and now they're acting as resistance. You guys know that I love uranium. I'm massively bullish on uranium, but we're seeing right now warning signs that we could be, clean this up a little bit, that we could be entering into at least a daily bear market. Now, if we switch over to the longer time frames, you'll see we're still pretty bullish on, I should have pulled up one of the other charts, still pretty bullish on uranium as long as we don't take out this previous low of $51. So it's definitely worth paying attention to that we could easily have a pullback as low as $51 without threatening the overall trend. But we are seeing here on the weekly, we have gotten the 821 across the downside, and it's looking like a rejection at this point in time. And the bears are very clearly in control. And then if we just switch out to the monthly, we'll see that that key level of support would be the 21 at like 54.94. And obviously momentum is building to the downside. So but I do still love uranium. I'm not trying to be a hater on uranium, but we had a nice little 2 years. It's time to just relax and let it do its thing. And then we can look to, you know, get back in when the time is right. You know, and I do still have small positions still open. You guys know my strategy. I like to keep small positions in things based on profits that I just leave alone, forget about, and they go from, you know, a swing trade or a scalp into a profit, and then I just keep part of that trade and it becomes an investment, and I just set it and forget it, and I'm just not worried about swinging in and out of it, and I don't care. And that's essentially just how I build a long-term portfolio in the various different things that I trade. Did the same thing in crypto all through like the bear market and into the bull market, and then you end up with a bunch of just random trash cryptos. And then once you feel like, you know, a cycle is topping, then you can go back through and start legitimately selling off those positions, taking profits, because you don't want to have to worry about like, you know, an 80% drawdown if we go into a multi-year, you know, cyclical bear market like what we're expecting in crypto. You know, and then if you're wrong, you just enter back into it. But that's my strategy. Everybody else has to develop their own strategy. You have to do what works for you. I'm always glad to share the way that I do things, you know, and what I have found successful. But you may find something completely different will be successful for you. And that's the best way to do it. The best way to do is, figure out what works for you and do that. So THCX. So this is just a cannabis ETF. This one just has, there's a bunch of different ones. You can look at individual cannabis stocks. This gives us a little broader range of the market. This has 3 of the main cannabis stocks that I, have individual positions in or have been building positions in, as well as like a little taste of some other stuff. So it has in it ACB, Aurora, Tilray, and Canopy Growth. And, oh man, I can't even, hang on one sec. I can't even think what else is in this one. Oh, Kronos also. Canopy, Tilray, Aurora. Yeah, okay. There's some other just random stuff in there as well. But, just as a proxy basically for, the overall pot stock market. You guys know, obviously, I like Hexo as well. But this ETF, essentially, we've been in a bear market for some time. We have lost the 821 for some time. We had a fake out cross back here at like 1250. And then since then, we lost half our value again. So is it possible we get another fake out cross right here again? It 100% is. And we see very clear bullish divergence as we're putting in new lows on price, but we're putting in higher lows on our indicator oscillators. Getting ready to have that 821 cross. So we could be setting up for a big move right here. And what amounts to that reversion to the mean play. So that would obviously be, obviously if we push back up to the 200 exponential or simple and then just got rejected, we're talking about like a 50 to 60% move right there. So we don't want to get too excited now because we could easily see a rejection like this. But there's definitely some potential right here. Just looking at where we're at right now, if we were going to go ahead and take, a short-term trade, not build a position in this, let's say, what we would be paying attention to is the bottom of the range. If we took out the low, obviously that doesn't look good. But if we look at coming back up for the reversion of the mean play at like a 40, 45, 50, 60% move, something like that, we're essentially looking at a 15% stop loss with a 45% potential like upside target, which is giving us over 3-to-1 risk reward ratio. So that's a nice risk reward ratio. We basically flip a coin. If we're right, we get $3. If we're wrong, we have to pay $1. So that's a nice risk reward ratio. As we start to see this confirm, we see we're building up momentum. We see we have bullish divergence. We see we have the 821 potential cross. We have a key definable level. And then also, obviously, this was our previous support level that we started to base out off of and then failed to break higher. And then that would obviously be a key resistance for us to pay attention to as we see there's a bunch of price action around this level. And that once again is going to correspond, somewhere around this level. It doesn't have to be perfect. Looking back here, it looks a little bit like it's higher right there. Here, you could argue it's slightly lower right there. But regardless, somewhere around there is where our target would be potentially, corresponds with the 200 exponential and simple. So while I don't like having a big stop loss like this, 3-to-1 risk reward trade, you can just take a smaller position. If you say you wanted to take the risk $100, you just look at the $100 and then look at that as 15% of your position is what you're willing to risk. And then you just multiply it out to figure out how big of a position. So we just make the 15% stop loss equal to the $100 that we're willing to lose. And then if we're right, obviously we would make $300 on the position. If we're wrong, we would lose the $100 because it's a 3-to-1 risk reward ratio. And then we can calculate position size accordingly based on our risk reward. So it works both ways. Now, I don't like to have 15% stop losses. I would rather have a tighter stop loss and just see. But at the same time, there's many different ways that you can trade or, arguably invest. But I am building positions in miners currently and also pot stocks as well. But I would not be surprised in the least bit to see them put in a lower low than they already have. And they are beat down bad for sure, especially pot stocks. So lumber. So just paying attention to lumber again. We saw consistent, basically just limit downs. Consolidated off the 200 exponential and simple. And then once again, we saw consistent limit ups. I mean, this is obviously not organic movements on people that have anything to do with lumber. This is full speculation. But we do need to pay attention to the high right here and then potentially a lower high. But obviously on the macro, we have a high here and then we got a lower high and then entered into a downtrend. So last thing we want to see is obviously this would be a lower high on the macro, but we see a high then a lower high on like the internal. So if this is our peak and then we have a lower high here again, we need to be careful because as soon as we take this out, we're breaking back down below 200 exponential and simple, etc., etc. We also see a massive volume spike right here. So typically volume spikes will correspond with tops and bottoms. So we see big volume spikes here. That was the macro top. We see big volume spikes here. Now this was technically like the bottom right here. And then this one was technically potentially the top. So a lot of volatility in lumber, but this is obviously very speculative right now. It's not like there's like people running out here to like use the futures market of lumber for like what you're supposed to use it for, or like traditionally would. So let me jump over in the comments here and see what's going on. What up, CW? Good to see you, my man. Hey, always glad to share my time and my technical analysis with you guys. It also says, if the economy is heading south, would not silver lose its usefulness compared to gold? If the economy is heading south, would silver not lose its usefulness compared to gold? You know, and that was the discussion I was having about commodity versus monetary. So, like, commodities will be more in demand in a bull market, a strong economy, because everything is growing and we're using those commodities to build infrastructure or build products or whatever. So that's where the commodities would come in, like copper and then arguably silver. And then in a time of uncertainty, potentially like a recession or depression or stagflation or whatever, potential situation, we could actually see gold hold its value much better because it would be more of a fear trade and more of the monetary value being important. So that's where the distinction that I was trying to make earlier really comes into play. And silver is sort of in the middle, but the real use for silver is a commodity. And then there's also some people that like collect it and use it as a store of value. But that's not significant players. That's like people, silverbacks, silver stackers, regular people. That's not central banks. And in all reality, central banks are what matter. The two most important things are, to gold is central banks. To silver is, people that need it as a commodity to like build stuff. So, Elon Musk and Tesla and, people that are using it for something in manufacturing. And copper, obviously the same way as a commodity. There's going to be some idiot out there who's buying like, copper coins and stacking them. But like what percentage of the actual copper demand and market is that? Tiny. Now, if they start building like massive infrastructure in like India or Africa and using massive amounts of copper, that's where the real value is coming from. That's where the real demand is coming from. So switching over to DXY. And also, if you're in the comments and you haven't said what's up yet, feel free to drop a what's up or let me know where you're at, what time zone, what country. Just an emoji. I don't care. Say hi. It's always nice to hear from you guys and get some sort of reaction from you. So DXY. So obviously we saw once again, we had a little top right here. We had some very clear bearish divergence. We had a pretty heavy sell-off. Put in another higher low. Now we did come back up and it looks like we're going to cross that 821 back to the upside. Looks like the dollar is going to continue strengthening compared to the other currencies in the basket or just other currencies in general. And you guys know, obviously, even though this is only technically the DXY is compared to a basket of specific currencies, we use this in many ways as a proxy to the dollar in comparison to like all currencies. Although this doesn't technically represent that, it does on the most part. So obviously very bullish, continuing to be very bullish, but we do expect a kind of sideways price action for now. But I mean, it looks very strong. It really does. Still looks very strong to me. And if we cross 821 back to the upside, and we put another high, and then we potentially put in maybe another drive of bearish divergence, maybe we take that out and see continuation, this is going to put some serious pressure on a lot of things. So Tesla next. So Tesla did obviously what we've been discussing. We obviously peaked out, put in a lower high. We have the low, we have a lower low, and now we try to push back up here again. We're at the 200 exponential and simple. The slope on them is basically flat. They're not looking so great right now. We'll have to see. The key level to get back above was obviously 1,000. We were unable to do that on this pushback up. So the key area to watch breaking down from is like 830. If we break down below 830, that's losing the 200 simple, and that's also taking out our local low. So both those things would look very bad. And then we obviously would start looking at, once again, stepping down as we go. But we would start looking at like 755 as our next downside target on Tesla, which arguably you could say like 781. We kind of have like this red line in play off of that like previous peak right there. But that was on our breakout on the way up. I would be more inclined to look at it more on like the actual close, which is closer to like 770, something like that. But again, we just know we're watching these key areas. We're obviously trading down in some sort of like descending channel / whatever pattern, except for that little peak out the top. So NVIDIA next. Obviously, this is, in many ways a proxy for our semiconductor space. We can look at like an actual semiconductor ETF, but NVIDIA has been arguably the strongest. AMD hasn't been bad either. Micron, a couple other ones. But I just look at NVIDIA, strongest horse in the race. So if it's looking bad or not looking good, the weak stuff like Intel and Taiwan Semi and stuff are probably looking really bad. So if we look at the best one and it looks bad, the worst ones probably look really bad. Really, really bad. So if we see here, obviously, it's starting to look like, we had a massive run up on NVIDIA here. We threatened the 200 back in 2020. We threatened the 200 here in like 2021. And now we're threatening the 200 here again in 2022. So if we find support here and continue, everything's gravy. Semiconductors still booming. Everything looks good. Maybe we're wrong about what we're seeing in the other 3 horsemen of our 4 horsemen duo, or whatever it would be. the duo times 2-0, the duo squared. But if we see our, other 3 horsemen showing us signs, and then all of a sudden semiconductors start shooting to the upside, hey, maybe it's not going to be the top, whatever. That's fine. All of a sudden maybe we see energy keeps running. All of a sudden maybe we see semiconductors rallies back to the upside. All of a sudden, transportation starts juicing back up and moving. Maybe the yield curve inversion doesn't happen. Sure, that's fine. We can readjust based on that. But what we see here is potential that this semiconductor is starting to roll over here. So if we lose these key levels, which would be basically a 200 exponential and simple, this is going to start looking like serious danger zone. And obviously, we have the low right here. We bounce it. We get a pathetic bounce off of it. And now we're coming right back down to test it. And you guys know my bouncy ball like theory or my helium balloon theory. When it comes to support, I just picture your desk in front of you and you just drop a bouncy ball from like a couple feet up. The first bounce is going to be the highest and then slightly less high, less high, less high, less high. And then eventually it's just rolling and it just rolls along the 200s, rolls along the support, whatever it is. And then eventually it rolls off the edge of the desk and it falls. And that's when we get that bloody waterfall, like many of the tech stocks have been doing. Or the Russell. So that's what we're paying attention to. And, the opposite way for breaking through, resistance, which Tesla was a great example for that. But, each time you hit that resistance, you come down a little less low. So imagine, there's a ceiling and you have a balloon full of helium and you release that balloon from the floor. The first time it hits the ceiling, it's going to bounce and come back down, say a couple feet. And then the next time it's going to come back up, hit the ceiling, and it's going to bounce off the ceiling a little bit and come down a little less. And then a little less, little less, little less. And then it's just sitting on the ceiling at resistance. And then eventually, if it sits there long enough and just kind of keeps bouncing, eventually there's no more ceiling and it just finds its way out the door and then goes to new all-time highs or whatever. So that's like kind of the metaphor, the bouncy ball versus the helium balloon. So Apple. So we're just going to look at the big drivers, the like FANG. Well, is that even a thing anymore? We'll have to make up some new one because for me, the ones that matter are Apple, Amazon, Microsoft, and Google. Facebook is irrelevant trash to me at this point in time. You guys know I have badmouthed Facebook for some time now, so it was not a surprise to me to see it get absolutely wrecked. You guys know how I felt about Netflix. that it was also trash, and that Squid Games was literally like the one thing that saved Netflix basically from just being absolutely horrible. And then, a lot of other things that I've called out as trash for some time have just gotten absolutely wrecked. I mean, Peloton, for instance, total trash, got just completely creamed. Kathy Wood, ARK, absolute trash. The list is very long of the things that we have called out perfectly that have gotten absolutely wrecked. So as far as I'm concerned, Facebook, trash company, trash stock, and it's off the list. So not even looking at it anymore. But Apple, Amazon, Microsoft, Google, very much important to these markets right now, as they are essentially like holding them up. And, NVIDIA as well, obviously, is a key player and, has a heavy weighting in these key indexes. So, but Apple, again, we have to be very careful here that we're potentially putting in a lower high. Apple has been very strong. We broke through the key resistance right here, came back and didn't even come close to testing it. So if we break down from this level again and we come down and we test this 200 exponential, or we tag this red, what was resistance, could be support line, we have to be very careful watching that. And it looks like it's rolling over for a lower high. And this is how markets top out. You typically see a high, then you see a lower high, then you see a lower low, and now we're in a downtrend. Excuse me. Sorry about that. So Apple definitely looking weak right here. Stronger than most, but looking weak for sure. So Amazon obviously has been trading inside of this channel for, 100 years now at this point in time? Not 100, I'm sorry. Since July of 2020, the most boring stock in existence. Amazon has literally been trading sideways since July of 2020. We could arguably redraw this channel slightly higher, but as far as I'm concerned, this was just like Wyckoff distribution, 2 failed breakouts to the upside, and then we had obviously, a spring potentially down here, and then we're just right back at the middle of the range. Typically what we see happen is, here is a perfect example. We top out, we come back down to the bottom of the range, kind of trade sideways, come back down to the bottom of the range, break out to the top of the range, come back down to the heart line, and then we break out to the upside, but it failed. So we retest the heart line, and then retest the heart line, and then we break out again and it fails one more time, and we put in a lower high. That looks like clear distribution. So then we sell all the way back off to the bottom of the range, we come back up to the heart line, and then we get rejected. Just so happens we're technically in a bear market on Amazon right now also. And now what typically happens here is, after this rejection, we come back down to the bottom of the range, we bounce it, we do the bouncy ball, and then we fall out the bottom. And when we fall out the bottom, we have to be very careful because our measured move is going to be, I'm stealing this from before. Our measured move is going to be the width of the channel. So if we do break out to the downside of this, that's going to give us targets down here of like key previous levels of what were, resistance to potentially act as support. So we have a very clear resistance level at like 2042. And then we have our measure move is somewhere around like 2,297. Now, me personally, I look at Amazon pullbacks. If this is distribution and we sell off here and we come back down to these key levels, I would be looking to build further Amazon positions because I think Amazon is extremely bullish going into the future, 5 years, 10 years, 20 years from now. But that does not mean that Amazon cannot get .com bubble bursted again. Now, I don't think that it would have the same, I know with pretty strong confidence that it would not have the same type of 90+% pullback as it had in the .com bubble burst. Because back then it was not a profitable company. The same way that we see all these trash stocks now that are tech stocks that don't make money, the don't make money, don't make sense stocks, as I like to refer to them. Those ones are getting wrecked right now. Amazon is holding. But if Amazon sees a 20 or 30 or 50% sell-off, I will look at that as a buying opportunity to build a position into it because technically and fundamentally, I like Amazon. But it does not mean that I'm just going to jump on it at the first opportunity. But I will be bullish long-term as an investment. So I hope I did a good job explaining it. But, they make money. They're a legit company. But it does not mean they don't have further downside. And they are very clearly entered into a bear market based on my metric. Not, they're down 20%. Bear market because we're Wall Street. Microsoft, still looking stronger. Obviously been putting in highs. We obviously had a very clear ascending support line, and then we put in a series of lower highs, and then we saw a pretty big dump. Got bought up aggressively off of the 236, but now we know what that means. From our retracement in March of 2020, the CVD to the top right here, we know now we tagged the 236 perfectly, and that was also a key support. And then off of that, we bounced back up, and now this is starting to look like, left shoulder, head, and then right shoulder. So if we come back down here to the 236 again, we lose the 200 exponential and simple, which we're technically below, and they technically have like basically a flat slope. If we just go sideways right here, they're going to flip over negative. We're going to get a red and pink slope on the 200 exponential and simple. We're going to retest the 236, and then it's going to look like a head and shoulder, and then we're going to get the measure move of the head and shoulder. Now, do those things have to happen? No, of course they do not have to happen. But when we see something happen enough times over and over again, we know that the probability of it happening is much, much higher. And I could probably draw that a little cleaner if I just sort of did the head as like kind of a double top like that. But essentially that's what I'm looking at. That's basically what it's looking like is going on right now, technically. So we'll have to wait and see. Obviously the pattern has not developed yet. We were expecting something similar to this like with the Nasdaq, and it just broke straight through. This had that perfect dead cat bounce, came up slightly above key levels, and now it's looking very likely like, that's what's going to take place. Now, obviously, we'll see what happens. We're probably not going to get this full measure move on a breakdown here, but, at least to the 236, potentially to the 0.5, and then we can start looking at like macro support around like 242 or 215, something like that for Microsoft. But we know this has been one of the strongest stocks throughout this bull run and literally been holding up these markets based on performance and obviously weighting as well. So Google, obviously, once again, we saw that massive gap up, and technically took out the high right here. So that was just a massive short squeeze, in my opinion. Gapped up above people's stop losses, took out the all-time high. People assumed that it was going to go higher, and that was a momentum trade. Bought into it, and then it just capitulates straight back down, fills the gap, and now here we are right back down at the lows again. And this looks like it's just going to roll over. It looks terrible, because how can you possibly be bullish after a massive boost up like that and then just completely bleeding back out and giving it back? It's very clear that there's no buyers at these levels. It's all sellers. So what would I expect? I would expect selling to continue. So I think now this momentum is going to just absolutely wreck people as this just starts to capitulate to the downside. Obviously, I love Google, and 100% Google is just amazing. They're a great company. They definitely don't censor people's search results or anything like that. And then, obviously, I would never speak ill of our current platform that we're currently utilizing. They're obviously great, and they 100% don't, mute people's comments if they say anything about like particular political parties or, doctors in charge of Pandorama situations, the CVD. So no, I love Google, and obviously YouTube is great. I would never speak ill of them. Not that they would censor me or anything. Not that they have censored me on many occasions or shadow banned me. But overall, doesn't look good. And again, one of the strongest ones that's in literally holding up these markets. All right, let's keep on rolling, baby. What's up, Honkiness? Good to see you, man. What's up from Mexico? Okay, hell yeah, bro. Hope you're having fun down there in Mexico. Enjoy your vacation, brother, man. Drink some tequila and some of that authentic Mexican food for me, man. I'm jealous. I'm jelly. Yeah, definitely been missing the vacations through these last couple of years. I travel a lot normally and have not been traveling at all these last 2 years. Had like one short little like vacation trip like here and there. Had a little family come down here to visit, but it's definitely been a little different. Looking forward to getting out and about. So definitely respecting you on that one. Have fun on your vacay, my man. So Bitcoin futures chart. Let's keep rolling here. So, okay, obviously we're in a very clear descending, whatever you want to call it. It looks a little cleaner on the spot market chart as just a channel. Looks a little bit like wedgie or descending broadening wedgie on this chart. But essentially, we got the move back up. We retested the 200 exponential and simple as resistance. Looks like a pretty hard rejection. Had 3 straight days of, thick red candles, essentially just wiping out those gains. This is just a dead cat bounce or bullish move after a long bearish jump, in my opinion. And then it looks like we're just going to roll over. Now, we did build up a little bit of momentum here on the TJD TDMACD on the daily. We did make it inside the bullish control zone. So if we sell off here, find support at a higher low, it's possible we break back through this and reclaim the 200 exponential and simple. But I am not particularly bullish on crypto considering everything else taking place, as it has been very much proven not to be a store of value at all. It's the worst store of value ever. It's definitely not digital gold. It's 100% the most speculative asset in existence. And as it's been adopted, obviously, by like Wall Street, Main Street, which everybody's praying for that it would go mainstream, it's very clearly just become completely correlated to the Nasdaq and tech stocks, just exponentially to the upside or to the downside. So, if we expect the Nasdaq and the stock market not to do particularly well, if we expect rates to rise, which causes the most pressure on the most speculative assets, we would expect crypto to probably just get absolutely wrecked. And that's what it looks like is going to happen. But at the same time, we're not going to let our bias, based on what we think is going to happen, determine what we see on the technicals. So right now, there's still potential for some short-term upside. This was potentially the move we were talking about for a inverted head and shoulders. We basically have a left shoulder here, neckline, head, neckline, right shoulder potentially here. So if we found support and we retested back up, we would essentially have like a slanted resistance. And if we broke through that, we could get a nice measured move back up into like the mid 50s, maybe 55K, something like that. But let's not get too excited yet, because crypto will probably go to zero. It's going to zero. Bitcoin's going to zero. That was my special shout out to, I didn't realize that for like 2 years, I've been doing the whatever asset blank here is going to zero, and that no one had any idea what I was talking about. So I finally shared that video randomly in the group the other day, and everybody was like, oh my God, I've never seen that. That's hilarious. And I'm like, for 2 years, I had an inside joke and I was the only one who thought it was funny. So yeah, if you haven't seen that, just Google Bitcoin's going to zero, because everyone should see it. It's freaking hilarious. So spot market chart, I got the Bitstamp chart brought up here. Again, we saw that bullish divergence. We got our break of our descending channel. Okay. If we look at the measure move, this was our measure move, which is just the width of the channel from the bottom to the top. And then obviously we just had that at a random area we could break out somewhere roughly. And then, we basically just retest the 200 exponential and simple. That was the move we were waiting for. We got the move. And now we have to just be patient and see what happens. We don't want to get greedy here. We definitely just take profits off the table and then wait and sit back. We could literally just enter back in now and we would be at an advantage. But there's no reason, because we're seeing weakness. So maybe we come back down here, retest this as support. Maybe we find support where we're at right now and we get that move back up. Maybe we just sell back off and continue going lower. Any of those are possibilities. We are getting a hard sell right now on spot markets, and we have clearly left the bullish control zone. We're getting all red histograms, and we're losing key support levels after, what amounted to a pretty pathetic breakout after months of just getting absolutely wrecked. So in my opinion, crypto does not look particularly strong here. If we switch over to the weekly, yeah, I don't think there's anything too important right here. If we switch over to the weekly, this looks like a pretty hard, and I mean like hard, rejection off of the 821. I mean, this is literally a topping candle right here. So this is obviously a shooting star. If you're not familiar with like candlesticks or candlestick patterns, that is one of the things that, will tell us some of the like shorter term. A candlestick will tell you, hey, look out for this. Yellow light, red light. A candlestick pattern will tell you, hey, there's something developing on the chart here. And then an overall like chart pattern, like a head and shoulders or something like that, is a series of candlesticks and candlesticks pattern leading to like a chart pattern. So it's just like different progressions of, what's taking place on the chart. I like to use all of them. I mean, I like to have the more tools on my belt, the better, in my opinion. I like to think of myself as like a, technical analyst version of Batman. I got like that utility belt with like there's stuff in there that I haven't even busted out yet. You don't even know what's in some of these little utility belt pockets, okay? I don't even know what's in them. I forgot. Might be something in there we might forget we even had. But one day. So obviously this is a rejection and it looks like we're just going to go lower. So when we start taking out key levels, maybe 37.8, this is going to be a key one. If we come down here on a weekly and take out 36.2, that's going to look really bad. And then obviously the main one, the key one that we need to look out for is like 31.7. Bears are very clearly in control right here on the weekly. Now also obviously bearish control zone. We saw triple bullish divergence and then we got to push back up here. So it's possible, you know, this was a good chance to buy and we should keep our position open and we'll see continuation of the upside. But we're definitely seeing warning signs. The last time this happened, you know, we did not see, you know, a rejection candle like that. We saw a big powerful candle and then a big powerful break and then continuation. This time we saw a big powerful candle or series of candles, a rejection of lower prices, a big powerful candle back up to resistance, and then a rejection of higher prices. So I think it's more likely now that we come back down and retest the bottom of the range, as now we've rejected lower prices, we've rejected higher prices. So as far as I'm concerned for right now, we're probably going to stay range bound between 42,500 and 36,250 on the weekly time frame. So we basically have a $5,000 zone that we're looking to sell the top of and buy the bottom of for now. And then if we just go to Ethereum, very similar. Obviously Ethereum, descending pattern, rejection off 200 exponential and simple. Looks like it's just rolling over. We got to be real careful with this one. Obviously it has broken down from our key pattern, you know, got our move back up to resistance. So we had obviously the yellow resistance, hit our move to the upside. And now we're seeing resistance on the moving average and then also our red descending trend line. And then we see our Bitcoin dominance chart on the weekly here. We have triple bullish divergence. We have very clear channel that we've been operating inside of. We have broken above the 8 and 21. We're moving back up towards the top of the channel as expected. Bitcoin is gaining value in relation to the altcoins. So the alts are total trash and they're getting wrecked right now. Bitcoin is also trash, but not as trashy. So it is gaining value. The same way we talk about the relationship between gold and silver, we talk about the relationship between Bitcoin and the trash coins. So obviously, if we get a break of this range, which every other time we've gotten rejected, so the most likely scenario would be us getting rejected, we have put in a hypothetical situation where we move back up to the top, we get the measure move, we come up here, retest 200 exponential and simple, we get rejected, we come back down, we retest what was resistance as support, and then we see continuation back to the upside. All the altcoins go away, they die forever, and then Bitcoin becomes king again. It's world reserve currency. We build a rocket ship. You know, we call it the Citadel. It looks like Peter Schiff and it's made out of pure gold. And then we all fly to Mars with Elon Musk and we live with the Martians. You know, that's best case scenario. You know, maybe it doesn't work out like that. Maybe it does. I can't see the future, but I think I'd give it a 50-50 probability. But I'm only getting on the Citadel gold rocket ship if it looks exactly like Peter Schiff. It's the only way. And then the weekly Bitcoin crypto cap chart. That was obviously the Bitcoin market, Bitcoin dominance chart. And then here we have the crypto market cap chart. Total value of crypto. Obviously in a bear market, rejection off of the 821. On the weekly, technically it's not in a bear market, but you know, we obviously see what's going on here. I prefer to look at both these on the weekly as opposed to the daily because it gives us a bigger picture. The key areas to pay attention to are, you know, if crypto's market cap comes down to like 1.66 trillion, or obviously down here at 1.25 trillion, and then we have the 200 exponential and simple moving averages, but looks very bearish. All red histograms for months. Very red slope line. Bears are clearly in control. Bearish control zone. Below the 8 and 21 cross the downside. Crypto just looks like trash. Looks like trash. Soto says, now I get it. Oh, wait, I skipped one. Hunkiness says it's one of the few places that accepts pure bloods. That's fucking amazing. I've never heard anybody say that, but I'm not going to read the last part of that comment just because, but that's fucking awesome, dude. Pure bloods till we die. That's fucking awesome. But yeah, that's going to go ahead and do it for today. We are probably going to start going to 3 streams a week. So we will see our regular Wednesday stream, and then it looks like probably going to be doing a Friday stream from here on out. So more than likely, this week will be our first Friday stream. So it's going to be every Sunday, every Wednesday, and then every Friday. Might do Friday mornings. Possibly we'll do a Friday market wrap-up. So I haven't decided if it's going to be morning or evenings Eastern Standard Time yet. But most likely this will be our first Friday stream. I will let you guys know for sure on the Wednesday stream, and then obviously group members as well. But that's going to do it for today. Appreciate everybody who tuned in. Hopefully you enjoyed the stream. Protect your capital, protect your principal. Obviously, we are at key inflection points in the market, in the economy, and obviously in our geopolitical scenarios as well. Be careful with this whole gold situation. Be careful with, everything happening with the 10-year treasury, DXY. We're seeing some crazy moves. Crypto potentially. Don't want to get wrecked this close to, a potential life-changing opportunity to, really grow our wealth. So, but that is it for today. I appreciate each and every one of you, all the positivity, all the group members. Welcome to our new group members as well. I do still have one more opening that we are looking to fill. That was basically our goal to move on to the 3 streams a week. So assuming that we get that filled, we're going to go ahead and start doing 3 streams a week. So appreciate all you guys that have shown your support in the past and continue to show your support. You do obviously get some nice benefits, access to the fresh Jewel indicator, the Jewel Thief that I use on stream, and then obviously the TJD Master as well, the moving average indicator. And then regardless, even if you don't want to show your support, that's completely fine too. Totally understand. There's tons of other free indicators available. You can just go down into the description and find those on TradingView, and a bunch of other awesome resources as well. Tons of playlists to help you learn technical analysis or to explain how to use those indicators as well. So, but that is it for tonight. Appreciate each and every one of you. Protect yourselves, your capital, your principal. Love your family. Take care of yourselves. And that's it for tonight. I will see you on Wednesday, 8 p.m. Eastern Standard Time for our midweek market update. It is February 13th, 2022. That's it for tonight. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Crypto Trend Trader, and I'm out of here.